Welcome to VTS Options. So in the world of options trading, simple puts and calls are in every strategy, whether it's basic or advanced. But there's actually a very big difference between the long call and what I'm going to talk about today, the short call. It's a common misconception that these are just two sides of the same coin. But actually, these are entirely different trades with radically different risk-reward profiles. So it's best to view the short call in a category entirely of its own. So subscribe to the channel for more options trading content, hit that like button for me, and let's talk about short calls. This is what the risk profile of all short calls looks like. This will be the underlying stock, ETF, or index's price. And then on the left is the gain and loss. So let's learn with this hypothetical example. We've got stock XYZ currently trading at $55, and we're going to sell a $55 call for $5. In your trading software, you would just sell to open a single leg call option. Now this shape here is the short call risk profile at expiration. But with options trading, at least for the VTS community, we rarely let contracts actually go to expiry. So we're mainly focused on that curved pink line, which is the daily profit curve. Now it starts at 0, of course, when we initiate the trade on day 1, and then it'll move up and down in real time depending on the current profit of the trade. So a few things we can highlight here. First of all, the maximum gain for short calls is capped at the premium collected. So in this case, we're selling the contract for $5. We multiply that by the options factor of 100 because one contract represents 100 shares of the underlying, and we see that our max gain is $500. The maximum loss for short calls is unlimited because the underlying can technically just keep going up to infinity. So risk management, position sizing, that's going to be really important here because it is an unlimited loss trade. But this is what they look like. We want the underlying that we're trading to either stay where it is or go down. Anywhere in that range is going to lead to a profitable trade. So the option Greeks are statistical values that provide us a way to measure the sensitivity of an option's value with respect to other factors. And in our day-to-day trading, we really only need to focus on 3 of these. Delta is the option sensitivity to price. Short calls are delta negative, meaning they profit from decreases in the price of the underlying. It's a bearish trade. We want the underlying to go down, so it's delta negative. Theta is an option sensitivity to time. Short calls are theta positive, meaning they gain value with the passage of time. This is why they can make a profit even if the underlying doesn't move. That positive theta can still lead to profit. And lastly, Vega is an option sensitivity to volatility. Short calls are Vega negative. They lose value with increases in volatility and gain value with decreases in volatility. This is typically why when you're selling options, it's most advantageous to be doing it in higher volatility environments. Vega negative trades benefit from a drop in volatility, so having a little room for it to fall is helpful. Now that's not always possible in the case of the short call, as I will explain right now with an example. Okay, so here we are inside the Thinkorswim platform from TD Ameritrade, and we're looking at the S&P 500. We're coming in right to the end of the year in 2019, and we are at all-time highs. So like I explained before, the short call is a bearish trade. So with markets at all-time highs, it is a time when people start to eye this kind of trade. You know, the likelihood of a small pullback on the horizon is a little bit higher right now compared to, say, somewhere over here. So I'm going to take a small bearish position and just default to a stock that I actually trade quite often. It's on my watch list. I cycle through it a few times a year, and that's Bed Bath & Beyond, so BBBY. So today I'm going to do a short call here, just getting a little bit bearish on this stock. So we'll go over to the Analyze tab. As far as choosing the expiry, I typically like to go about 1 month out, but in this case we've got 18 days and then all the way at 53 days. So I'm just going to do a shorter term contract and take this 18. Now the calls are on this side, the puts are over here. Since we're selling a short call, we're just going to focus on this left side of the screen. Now you want to choose a strike price that has a decent amount of volume on it. So the 20, the 19, the 17.50. But you'll also notice the further away you go from the money, the smaller the premium gets. So ordinarily I'd try to go a little closer to the money to increase the premiums. But another way you can increase the premium, because remember we're selling volatility, so we want it to be reasonably high, you notice that there's an earnings date coming up. January 8th, 2020. So we're going to be trading through this earnings date, and that's going to increase the volatility, in turn increasing the premiums that we're going to be able to bring in. But because earnings does have a little bit of additional risk, I do like to go further out. So this 19 strike is going to be the one I'm choosing. So I'm going to sell to open a single call option. And this is what it looks like. So one of the most important things to remember with this trade, when you're selling short calls, you do have unlimited loss, right? The stock can keep going up against you and you can keep losing more and more money. So what I always recommend people do is reserve the full amount of capital required to actually hold the underlying shares in case of assignment. This is going to dramatically reduce the risk. So for example, we are doing the 19 strike here, and every one contract in an option is equivalent to 100 shares of the underlying. So that would be $1,900. If assigned, that's how much capital would be required to maintain this position. So I'm only going to sell one of these contracts per $1,900 in available capital. I'm not going to leverage it up and do 2 or 3. I'm going to keep this trade very small. Remember, I'm just trying to simulate a small short position in Bed Bath & Beyond. I don't want to put my account at risk over a single trade. Now, another thing people bring up is 76 cents on a 19 strike contract. That may not sound like much, but when you think about it, that's actually 4% value of the underlying. And this is only a 19-day trade. So if you view it through the lens of a quasi-dividend, that's equivalent to about a 4% dividend in just 19 days. If you're very cautious and you do all of these trades cash secured, and you just layer a bunch of them month after month, you can see how it starts to add up to a significant profit. Again, though, first and foremost, the number one key is reducing risk, so don't ever go more than one contract per the 1900 capital. But this is what the trade looks like. So right here, this is where the price is. It's a little bit off just simply because the bid-ask spread, but we'll put that right there. Now the break even at expiration is all the way up here at 1976. That's a pretty long way from where the price currently is. Nearly 16% just to get to the break even point 19 days from now. And for me personally, I always trade these with a 10% stop loss. So 10% of 19, of course, would be 190 additional dollars that I'm allowing myself to lose before closing the trade. At expiration, that's going to take it all the way up to 2166. This is a very large distance. And in this case, I'm definitely getting paid enough to take this trade. So that's one of the reasons I like trading these so much. This is a very slow-moving trade because I've focused a lot on that position sizing. But let's talk about the Greeks a little bit here because that will affect the trade. So the first one is the delta. You can see that negative number right there as I'm sliding around, minus 46.74. This is a delta negative trade. Remember, delta negative means it's a bearish trade. And that makes sense if you just look at the picture. Of course, we want the stock to either stay where it is or go down. It's a bearish trade. It's delta negative. The next Greek is theta. And you can see right here, it's theta positive, $3.92. Right at the money there, $3.51. That's a daily decay and it does increase exponentially. Being theta positive for this trade, what it means is, if the stock price goes nowhere, I'm just going to be collecting a little bit of money every day until it hits my max profit. With the short call, we don't have to have it go down. Just hanging out in this range or even increasing up to here, that's all going to be fine as well and we're going to make our max profit. So positive theta is a good thing here. Now the last Greek, the Vega, you can see right now we are Vega negative. When you have Vega negative trades, it means that the trade profits from a decrease in volatility. Ideally, you want to open these when volatility is a little bit elevated, so it can go down and it can benefit your trade. Now the catch is, when stocks are near or at all-time highs, that's usually when volatility is pretty low. So it's not always possible to get that high Vega. The reason I was able to achieve it in this trade is because I am willing to go further out of the money and then have that earnings date in the middle of the contract. As long as I'm giving it a lot of room, that is actually a decent way to increase the Vega a little bit. But again, I know I've said it, but I cannot stress it enough. Make sure you give yourself a lot of room from where the price currently is and only ever buy one contract per the full underlying shares. That way you'll never get yourself into any leverage trouble. By following these rules, short calls, which is a trade that people are a little bit worried about when they enter them, the risk can actually be managed very easily, and this is a pretty solid trade. I actually use these quite a bit. It's far better than outright shorting something because, again, I'm getting paid over here, and I've got all this buffer zone before I even start to really lose much money. So if you're ever trying to get bearish on something, you think, wow, it's a little bit overvalued, or I think it's going to go down, maybe the S&P 500 or something. Instead of outright shorting it, perhaps consider selling some cash-secured short calls. It's a much safer trade than people think it is. So that's the short call. To review all of those points really quickly, it is a delta negative trade. Whatever we're trading, the stock, the ETF, or the index, we do want that to go down. It's delta negative. Now, short calls are theta positive. So whatever we're trading, even if it doesn't go down, as long as it just hangs out in a range, we can still make a positive return because of that theta. But something to be aware of, short calls are vega negative. So opening them when volatility is already a little bit elevated, that is the best starting point. Now, like I said, when we're looking to sell calls on overvalued instruments, that typically is when volatility is pretty low. So selling short calls does oftentimes just have that vega headwind. Short calls have limited gain, which is capped at the premium that we bring in for the trade. And they're unlimited loss trades because technically that stock price can just keep going up. So it is best to only sell short calls when you'd be comfortable holding the short shares outright anyway. And lastly, when selling short calls, there is always the risk of getting assigned the shares, especially if it's in the money. So just best practices, you should check up on your trades at least once a day. So overall, there is some additional risk when selling short calls, but if you're aware of it and you manage it correctly, it can be a very good way to get short some of those high-flying names. So thanks so much for joining me here at VTS Options. I'm here to make you a better options trader, and that always starts with the fundamentals. So thank you for watching the video. See you next time. So if you're interested in options trading, go claim your free 2-week trial on my website. In that time frame, you'll definitely see a wide variety of trade types: iron condors, strangles, calendars, earnings plays, pairs trading. I have many profitable strategies that you'll be interested in. Come join the VTS community.